Welcome back, guys. Quinn here again to help you in your pursuit of success. Now, in this video, I'm going to be combining some personal finance and real estate content to help you effectively save for a down payment on your first home. So many of the tips I've given you in other videos are going to come full circle here today when saving for your first down payment. That just goes to show you how important my advice is, not only for saving money, but to be successful all around. A seemingly obvious, yet no less crucial part of saving for a home is not just knowing how to save your money, but how much money to save for your down payment. This is where it becomes extremely important to be realistic about your budget, your goals, and to start understanding how mortgages work and what your down payment options are. Sometimes it can be helpful to determine how much money you're going to need for your house and the timeline for buying it. Then you can reverse engineer that small amount of money that you're going to put aside each month in order to reach that target. So let's start by knowing what percentage of the home's price you need to pay as a down payment. Now, the minimum payment will always change depending on the price of home you're purchasing, but there are percentages we'll get into that are the most effective. For example, if you want to buy a $500,000 home or less, then you're going to need a 5% down payment. But if the property is over $500,000, but less than $1 million, you will need to pay 5% on the first $500,000 and 10% of the remaining price. So if you want to buy a home for, let's say, $600,000, then your down payment is going to be $35,000. This gets calculated by the first 5% of the $500,000, which is $25,000, and then 10% on the remaining, which is $100,000, and that 10% turns into $10,000, equaling $35,000. Now, depending on where you want to buy a property and the size of the home, the price will change drastically depending on where you are. For example, in Toronto, a condo will go anywhere from $600,000 to a home being over $1 million on average. So good thing you've come here to watch this video, because we are going to need to save you a lot of money for your down payment. Don't forget to go smash that like button and subscribe to my channel for more content just like this. If you hit that like button, this video can actually be seen by way more people and we can get the message across better. Now, of course, in life, the biggest financial hurdle you'll have to overcome is paying for a down payment. Great. But at least we know that a bigger down payment ensures that your mortgage payments don't leave you scrambling for cash each month, and you'll actually get decent rates on your loan. So the more you can save, the better. The rule of thumb here is having at least 20% of the house price as your down payment. Yes, 5% is the minimum, but I would definitely suggest 20, as this is where you get in a nice bracket so you're not paying crazy mortgage prices. This way you'll likely avoid mortgage insurance and secure more favorable rates from the lender. And another good thing about paying 20% is you'll be more protected against property price declines and ensure that your outstanding mortgage balance doesn't actually exceed your property's value. But now that we've gone over the basic things you need to know about your down payment, let's actually start getting into how you're going to save that money. I'm going to give you a list of 4 ways to save money for a down payment, and I'm going to do them in order of most liquid to least liquid, which basically means either money that is extremely easy to access and put towards your down payment, or that's less likely to access any given day. Number 1 on my list, and the most liquid, is a savings account. You're going to want to choose a savings account for your down payment fund if you want to use the money pretty soon. I would say within 1 to 5 years, and definitely on the earlier side of that. You're probably better served saving rather than investing this money, just because it won't fluctuate as much in the short term like it will when you invest it. The benefits of a savings account is mostly found in its convenience, simply because you can open an account very easily and you can set up auto deposit so that you're adding additional money every month into the account. You can also withdraw it very easily too in case you need that money right away for a home. You can set up a savings account for yourself that you use specifically for your down payment money, and you can just keep adding to it every month until you need it, and you will earn a little bit of interest on it. Again, this option works best if you're wanting to buy a house within 1 to 5 years, but more on the early side of that. Now, the second way to save is in a money market account. Now, don't confuse this with a money market fund, which I will talk about a little bit later. But a money market account is basically a hybrid between a savings and a checking account, even though it's not considered either one of those. Money market accounts actually act very similar to savings account, considering you can only withdraw 6 times per month out of the account, just like you would out of a savings account. But the account has some benefits because it actually has a higher interest rate. This means that when your money is sitting in a money market account, you're making a higher interest rate back just simply by letting it sit there. This happens the same as the savings account, but like I just mentioned earlier, you're making more interest and have a higher interest percentage on the money in your account than you would in a normal savings or checking account. Ultimately, a money market account is a good choice for someone who's looking to buy a house in more than a year from now, so you can let that money sit in the account and accumulate interest over time. Now, the third way to save money is in a money market fund. Like I said earlier, money market accounts and money market funds are different from each other, and I'll explain right now why. A money market fund is actually a type of mutual fund. And if you remember from my video, how to invest your first $100, I talked a lot about mutual funds and what they are and the different ones to invest in. So go check out that video if you need to learn a little bit more about mutual funds before you keep going with this one. Now, a money market fund only invests in extremely liquid short-term investments, which allows them to offer high liquidity with very low risk. In terms of liquidity, it's very similar to cash because it's so easy to access, but it's at a higher interest rate than a regular savings account, just like we talked about in the money market account before. Now, the interest you earn on your money market fund gets paid back to you in dividends. But if you're looking at me right now and going, oh, I don't know what a dividend is, it's very simple. A dividend is simply a term used for the distribution of money that a company will give back to its stakeholders. So whatever interest you make on your money market fund will get paid back to you. Now, these kinds of funds are pretty reliable, which is a bonus. But in order to access that money, you will actually have to contact your financial institution and request that it be given out to you. Now, technically, your financial institution or bank has to pay that money out to you within 7 days, but it usually doesn't even take that long. So don't worry about not being able to get that money soon enough. Unlike a money market account, which is better for saving a long period of time before you buy your house, a money market fund is great if you want to buy a house within the year because you're actually making so much interest in a short period of time. Now, for my fourth option for saving money, I would definitely put it in a brokerage account. If you know for sure that you aren't going to be buying a house within the next 5 to 7 years, it's never a bad idea to park that money in the stock market while you're saving for your down payment. Yes, there is more risk when investing in the stock market than, let's say, putting your money in a savings account. But if you have the benefit of time, you can actually use the growth from your investments as extra money to put towards your down payment. Again, I talk all about how and where to invest your money if you're new to the stock market in my How to Invest Your First $100 video. So go take a look at that if you need some more help with this. Now, don't forget to go hit that like button and subscribe to my channel for more personal finance tips and tricks and real estate content. I know in this video we've sort of wrapped the two together, but I assure you that they very much go together in real life as well. Also, don't forget to comment if you have any suggestions for future videos or anything you want to add to this one. I will definitely check them all out, and have a great day, guys. See you later.